Welcome to our podcast on small and mid caps. I'm Charlie Annis, European Small and Mid Cap Equities Senior Portfolio Manager at UBP. I'm here today with Eleanor Taylor-Jolidon, Co-Head of Swiss and Global Equities at UBP. Hi, Eleanor.
Hello, Charlie.
And we're also delighted to have Eduardo Lecubarri, Europe and Global Head of Small Mid Cap Equity Strategy at JP Morgan, joining us to discuss the world of small and mid caps. Hi, Eduardo.
Hello, Charlie. Hello, Eleanor.
So, Eleanor and I are going to give you an update on our strategies, performance drivers in 2020 and how we are positioned. And Eduardo, thanks for joining us. We thought it would be really interesting for our listeners to hear from a small cap strategist who's very well known in the world of small cap investing, but maybe less so amongst fund selectors and private clients. Eduardo, maybe you could tell us a bit about your investment background and your role as a small cap strategist.
All right. Well, I am the global head of a small and mid-cap strategy at JP Morgan. My clients are institutional investors who seek to benefit from investing in SMID Caps. And to help them do so, what I do is very simple. I have a process I have followed for the last 25 years that gives me all the data I need to understand the world of SMID Caps. That gives me a view of what is happening and perhaps more importantly, what is likely to happen next, which points me to those pockets in the market that I believe offer the best opportunities. And once there, I look for stocks that not only fit my top-down views, but bottom-up seem like good investments. And I then add them to my model portfolio, which I have been running since February of 2008. And it has delivered about 4,200 basis points of alpha since then versus the MSCI benchmark.
Great. Well, it's great to have you with us today, Eduardo. And maybe we should introduce ourselves and the main features of our approach to small cap investing. Eleanor, do you want to kick off?
Yes, sure. So indeed, we run Swiss and Global Equity in our team. And within the Swiss equity, we have a Swiss small and mid-cap investments, which follows very much the same approach that we have for all our investments, which is that we invest along the life cycle of cash flow returns on investment of companies. What we're seeking are companies which are either at a stage where they are creating value, which we would define as companies which are able to increase those cash flow return on investments that they can generate, or that they are maintaining those value creation, CFROI, at a high and stable level for longer than the market discounts. And that's where we really find very interesting alpha opportunities. But maybe you can say how you approach small cap, Charlie.
Okay, thanks, Eleanor. So our Europe small cap equity strategy is focused on investing in sustainable quality growth business models. Typically, we're talking about strongly financed, competitively advantaged companies with high or improving returns that are exposed to strong secular growth drivers in their end markets. We use a detailed screening process that leverages on our own watch list of candidate companies, as well as an extensive use of other systems such as HALT and Bloomberg. And we use these systems to identify specific features such as quality growth, undercovered gems, or high-end productive R&D. As part of the research process, we meet a lot of companies and we spend time engaging with senior management teams, including integrated ESG analysis and enhanced engagement for companies that are not covered by our research partners. And this helps us gain additional insights into how much progress is being made on ESG and sustainability. And Eduardo, I know you've been in Madrid for most of the year, but normally you spend a lot of time on the road. How have you gone about your normal business, seeing clients, seeing companies, and organising your annual small cap conference?
Well, COVID has certainly changed things, and I do hope that we will recover the human touch that is perhaps a bit lost when working remotely. But the reality is that in the short term, access to peers, investors, companies has never been more efficient than it is today. I have Zoom meetings pretty much every day, and the problem is managing the flow because given my global role, it can go from early in the morning till late at night. And the reason is very simple. We are no longer bounded by geography. So for example, our 10th annual Pan-European SMID conference, which will be hosted virtually next month, will be the largest we have ever done, with close to 100 companies meeting with over 150 investors from around the world, all through virtual meetings. Charlie, how have you gone about keeping in touch with your companies?
Well, it's really interesting to hear about how you've been getting on with working remotely. And we faced a similar picture in London, I think. All our interaction with companies, analysts and clients has obviously moved to a virtual format. And I think actually for the corporates, it makes for a very efficient use of their time because they can see more investors over a short period of time, no running around town in taxis and tubes. And as investors, we can be very selective about the companies we're meeting in a virtual format. And that helps us to be quite productive as well. During the course of the first lockdowns, we attended a lot of calls, either directly organised or group events, which enabled us to ascertain what companies were doing in the main crisis period in the second quarter. And in addition to our to normal quarterly roadshows for companies, a lot have organised update calls and capital market days, particularly busy at this time of year, or attended virtual conferences. And we've also organised specific ESG engagements with a large number of companies, particularly at the smaller end of the market cap spectrum, where there's less coverage, focusing solely on how they're approaching ESG and sustainability. How about you, Eleanor? Have you been able to visit any companies in recent months?
Well, it's been very similar to what both of you are describing. There was a brief hiatus during the summer where some physical contacts were possible with companies. Some of them were fortunate to have their capital market days at periods which were not in the lockdown. And certainly it was very appreciable to be able to see people physically, be they management or also other investors. And one of the aspects of my work which I find particularly rewarding is indeed talking to other investors and exchanging ideas, not just with my immediate colleagues like you, Charlie, but also with people from other institutions who have different ways of looking at companies, different concerns, different excitements about companies. And that is something that we've perhaps lost somewhat in this lockdown. But otherwise, I would agree, it's been very efficient, and I've certainly appreciated the availability of companies to continue interacting with investors, and also being indeed able to take perhaps more time, or simply because the situation is shifting on ESG, where we've been able to have very detailed conversations on that point as well, as that's very much part of our concerns also for the Swiss and global franchise at UBP. And with that, I think we can all agree that 2020 has been an extraordinary year. Eduardo, perhaps you could remind us about what investors should have focused on during the course of this year, and what has worked and what hasn't worked.
Well, my market views have worked well, and my stock picking is starting to work because investors have taken longer to move back into value than I had expected. I went into 2020 with a cautious view, as detailed in my Outlook report for the year. The reason for this was very simple. It appeared to me that all investors could hope for was single-digit returns, and those came hand in hand with a lot of risk, as this was already the longest bull market in history, and many metrics were warning that the economics upcycle was about to end. Now, on March 17th, I started changing that view and becoming more bullish for several reasons. First, 40% down in a single month was something we had not seen since World War II. Second, valuations had gone from all-time highs to being 20% below historical averages. And third, what was an outlook of single-digit earnings growth on peak profits was clearly changing to an outlook for 2021 of recovering margins and double-digit earnings growth from very easy comps. So I wrote back then that I thought this was going to be the fastest de-rating, re-rating story in the history of equities, but I just didn't think this recovery was going to happen in just 2 months. So since June 4th, my message has changed again, right? And I've been arguing that SMID Caps are range bound with no more than 15% upside because valuations are again demanding, again near all-time highs, and no more than 15% downside because we have 4 guaranteed tailwinds pushing SMID Caps on during the next 12 months. One is the world's economy, which will continue to recover. Another one is stimulus, which will continue to throw wood to the fire. The third one is the promise of double-digit EPS growth next year as margins recover. And the fourth is the vaccine becoming available. At the stock level, however, I have been, since March, focusing on those stocks that had fallen the most and offered the largest recovery upside. But these value plays, while they have delivered plenty of upside, they're only now starting to deliver alpha. That's been on my end. But Charlie, what has worked for you in 2020?
Well, as I mentioned, Eduardo, we have a preference for quality business models, and that means that in aggregate, we tend to over-index on higher cash flow return on investment and solid balance sheets. And for much of the course of 2020, the market has gravitated in particular towards companies with good, solid balance sheets that will see them through the uncertainty associated with the coronavirus crisis. And that's certainly been quite helpful. One of the style factors that's really come under pressure quite consistently during the year has been financial leverage. And I think the market will remain relatively nervous about leverage for some time to come. In addition, we really like the innovation that's on offer in the small and mid-cap arena in areas such as healthcare, financial services, communication services, and environmental technology. And during 2020, we benefited from a good level of exposure to these areas, which have, in many cases, seen an acceleration of the growth path that they were already on as a result of the pandemic. Eleanor, perhaps you could outline what's worked for you.
Well, serendipitously, we started 2020 with quite a defensive bias on our portfolios. Indeed, we were quite aware that 2020, prior to hearing anything about the pandemic, was likely to have a slightly slower growth profile globally as compared with 2019. And as such, we simply had positioned ourselves fairly defensively as we went into January. As the disturbing news of the pandemic reached us, we increased our exposure to healthcare, which is relatively easy to do also in the small mid-cap space in Switzerland. As you know, the Swiss equity market is dominated by very large healthcare companies, but that also has a feeder process towards some of the smaller opportunities in Switzerland in the different sectors of healthcare, so be it diagnostics, be it medical technology, be it biotechnology. And indeed, there have been some very interesting opportunities in those fields to play during the pandemic, not just because they were benefiting from the pandemic, but also because we could foresee how attitudes were going to change going forwards regarding health within society and where there would be opportunities into 2021 we would expect. There were also opportunities again linked to changing habits, changing priorities in some other more cyclical sectors indeed, but where we saw companies which would be able to benefit from this greater concentration about what kind of air we breathe, what kind of level of tolerance we have regarding the atmosphere that we're in, the ability to clean surfaces, what have you. And there were a number of very innovative players in Switzerland which could feed into those trends that we could see developing during the year. So we really realized to what extent, when you're faced with a crisis that the world is unprepared for, it's important to be an active investor, be able to move in the direction of the opportunities which the market that you're working on serves, and the very global nature of the Swiss small mid-cap space certainly offered us some interesting opportunities.
So it seems like, you both have been focused on the right things, but do you see, looking back, do you feel that that positioning had to change much during the course of the year?
We certainly went more defensive and probably more towards healthcare at the beginning of the year. And as the year progressed, and certainly as we look forward to some of the drivers that we would expect for 2021, so the exit or the softening of measures around the pandemic, we have started to think more selectively about taking on some more cyclical stocks. I'm fortunate working on the small mid-cap market in Switzerland, where we don't face some of the leverage, balance sheet strength differentiations that Charlie referred to, because we have a number of entrepreneurial run companies which have a tendency to have almost overly strong balance sheets to support their activity in Switzerland. So I wouldn't say that we would be taking on more balance sheet risk, but certainly looking to areas which may benefit from the economy opening up in 2021. But that's been quite late in the year and done quite selectively, because I fear that we might start 2021 2021 still, with maybe a less than linear development for equity markets and for economic growth. What about you, Charlie? Have you had to make much changes?
Well, it's been interesting, Eleanor. We noticed in March and April that there was a real polarization between the obvious COVID beneficiaries and obvious COVID losers. And there was a huge amount of companies sort of stuck in the middle, companies which are actually really quite good businesses, which got heavily oversold and in some cases underperformed quite heavily. And we managed to add to a handful of holdings which were falling into that kind of category, and have since recovered quite nicely. And we also participated in a few capital raisings. There were quite a few in the UK in particular, where we've got a system of tied corporate brokers, and UK companies were quite on the front foot with raising capital, often where they didn't need to, but just trying to shore up the balance sheet. And in many cases, that really has put some of these companies in a bit of a getting stronger position coming out of the crisis. So we quite like that. And we've been adding selectively to some of our industrial names, more cyclical names, and also travel and leisure related names, where we think that prices on offer look attractive, assuming we have a gradual normalization in earnings pictures during the course of 21 and 22. And a number of our holdings in this space we think will benefit from continued consolidation in their end markets, as well as a secular growth driver. On the flip side, we've been quite pragmatic about trimming some of the best performing healthcare and tech related names in the portfolio, where we felt that valuation had become a bit stretched. So similar to what you were talking about, Eleanor, it's been quite important to be pretty nimble in recent months. And finally, we've added to our exposure to environmental service providers, solution providers and service providers over the course of the year, because we see quite strong and enduring regulatory drivers in the end markets. And actually, interestingly, given the low levels of coverage and inefficiencies that we see in small cap, we've been able to find some pockets of real value in this space. Eduardo, I know you have a more constructive view now on quality value names. What areas do you think are going to do well from here on a 12-month view? And where do you see opportunities in terms of positioning?
Well, the good news is that while the equity market may be range-bound, opportunity at the stock level is still plentiful among SMID caps, right? Think about this. 30% of them are still down more than 30% from this year's highs. And close to 30% of them are still trading below 1x book, that is replacement value, right? So if you can find me a stock that is still down more than 30, with a balance sheet and free cash flow generation that ensures no rights issue is needed, I would buy that. And you can find many such opportunities in materials, industrials, and consumer industries, for example.
Great, thanks for that, Eduardo. Now, I know you've published some really interesting reports that we've enjoyed reading over the years on the longer term case for small caps. It would be great if maybe you could give us a brief overview of why you like the asset class.
Well, it's quite simple. The case for SMID has really never been stronger, and it's very easy to understand why. First, this is an asset class that has outperformed most other asset classes, and certainly large caps, through time, for reasons that are still true today. SMID caps are faster growing companies as they are smaller and are at an earlier stage of development. They benefit from M&A as they tend to be the targets that other companies buy at a premium. They're less efficiently priced, so those that go up tend to go up a lot, etc., etc. But beyond this, there are many reasons why SMID caps will be an even better investment going forward. For instance, economic growth during the next 20 years in developed markets will probably be lower than it was over the last 20 years. And Japan can serve as an example of what happens when economic growth slows. The Topix 100, large caps, is flat versus 20 years ago, while the Topix small cap has gained 2.5 times its value. Now, moreover, SMID caps are today trading at a discount to large caps. They're less exposed to passive investments that are adding unwanted volatility to returns. They benefit from increasing demand from asset managers and investors alike, who see in this asset class the last green field of opportunity. And all with history telling us, with tremendous consistency, that SMID beats large and delivers the biggest alpha during the first 3 to 4 years post a recession trough, which is precisely where we're now.
Great. Well, thank you very much for that, Eduardo. Eleanor and I have really enjoyed listening to your additional insights today. And thank you, everybody, for listening. Stay tuned for more podcasts on UBP expertise. And if you want more information, please visit ubp.com or contact us.